Thank you. I'm Susan Lund from the McKinsey Global Institute. Thank you to CED for hosting this panel and inviting me to be on it. We've got a terrific set of speakers to talk to you about debt, not just in the US, but globally. On your table, you have a report that was released by the McKinsey Global Institute that lays out some basic facts. So let me start by introducing our set of esteemed panelists. Then I'm going to give just a very short overview to put a framework on the discussion today. What are we talking about with debt and deficits? And is it going to harm economic growth? Are we going to have another financial crisis? What to think about it? And then I'm going to ask each of the panelists two different questions and then open it up to the floor. And we'd like to have this be very interactive and get lots of questions from the audience. There will be roving microphones around, and we hope we can get a good, lively discussion here. So on my left is Joseph Kasputys. He is a founder of Global Insights, a major macroeconomic forecasting outfit, and now president of Economic Ventures. We have Sabrina Schaeffer. She is the director of the Independent Women's Forum, and will bring a different perspective on debt. We have Doug Holtz-Eakin, who's the former director of the Congressional Budget Office and now the president of the American Action Forum, and Maya MacGuineas, who is the president of the Center for Responsible Federal Budget. Where do we start with the topic of debt? As Steve mentioned in the opening, since the global financial crisis, instead of having global debt being reduced or deleveraging, what we've seen is continued growth in debt. For me, at least, this was surprising. I started looking at this issue of debt and US debt, but then debt in Europe and in other countries in 2008, right after the meltdown of Lehman Brothers and so on and so forth. And at the time, there was a strong expectation that there had been a credit bubble, and now households, companies, governments would get their affairs in order, repair their balance sheets, and reduce debt. And for the next few years, we kept waiting to see this happen, and instead what we've seen in aggregate globally, we've got $57 trillion more of debt than we had at the end of 2007. The rise in government debt explains part of it. That's $25 trillion. Most of that $25 trillion is in advanced economies, Japan, Europe, and the United States. But beyond that, we've got growth of debt in the private sector. When we look at households, we can see that US households have actually reduced their debt quite substantially, as have British households, Irish, and Spanish households. But beyond those four crisis countries, as I call them, we see household debt has continued to grow quite rapidly in a whole range of countries, in Canada, in Australia, in parts of Northern Europe, Denmark, Sweden, Norway, and even over in Asia, we can see South Korea, Malaysia, Thailand, households continue to borrow. So there are big questions. Are those countries just housing bubbles and credit bubbles waiting to burst, or does something make that sustainable? When we look over at China, we see that's another big explanation for the growth in global debt. Over a third of all the increase in debt globally has come from one country, China. Its debt has quadrupled. It went from $7 trillion in 2007 to $28 trillion. It's an increase of $21 trillion. The figures are mind-blowing. Now, many of you are in private business, and many of you are probably bankers. And we have learned one thing in the business world. It's that when you grow very rapidly, it's really difficult to sustainably expand your operations. And that is very true in banking. While bankers can increase lending growth to quadruple it in 7 years and think that you've got good credit underwriting standards on that debt and prudent regulation and monitoring of it is just impossible. To make matters worse in China, about a third of it is coming from the unregulated so-called shadow banking sector. So a set of entities outside the commercial banking system altogether where their ability to assess loan quality, credit standards is completely unknown. Big question on China whether it can slow down the growth in debt at the time that GDP growth is slowing. When we come back to government debt, Greece is back in the news. Greece, ironically, has had 2 successful government debt restructuring programs in the last 5 years. And it's on track. It has a government budget surplus. It went from a massive deficit to a nearly 4% of GDP surplus. The IMF says Greece is projected to grow at 3% in real GDP terms in 2015. As an economist, I would say, wow, Greece looks like a success story. But it shows that even when you can achieve these fundamentals, the voters are tired of austerity and have said no more of the structural reform. They're in a very deep recession. Over 50% youth unemployment, over 25% overall unemployment, incomes have fallen quite sharply, and so there's been a political backlash against what could have been judged in economic terms as success. So that's the backdrop that we're going to have the discussion around. There are lots of topics here around government debt, private sector debt, financial stability. We could talk about student loans in the US. But I think it comes down to, if we live in a world with debt, how can we maintain stability, avoid the volatility and financial crises of the past, and actually learn to monitor and use debt sustainably? So I'm going to start with Maya down at the very end. The Wall Street Journal calls Maya an anti-deficit warrior. She has long been a very public voice about the need to reduce the US government deficit. So Maya, I'm going to play devil's advocate and ask you a different question, which is, isn't sometimes debt good? We're talking about debt as if it's always bad, but can't it play a useful role in, for example, funding infrastructure? And how should we think about what is the right level of debt or government deficit?
Good. Okay, thank you. And quickly, thank you to CED for hosting a terrific panel, terrific couple days. I'm glad to be a part of it. I've been a big fan of CED for a long time since I worked in Washington, and it's really great to see it thriving under Steve's leadership. And thank you to McKinsey for the global report on debt, which I thought was a terrific report and really looked at the issue in a very important way. Directly to your question, we actually, a number of years ago, a couple years back, wrote a report called Good Debt, Bad Debt, which is like about as exciting a headline as our kind of reports get. But you know, I think I'm in a role where we're constantly saying no, 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 and it's bad, bad, bad. And it's a really important point because debt plays such a productive role in the economy when used right. And I would put 2 main times. Sort of, debt is a necessary, a very important part of the business cycle. So, right after the economic crisis in 2008, suddenly, you know, we woke up, there were headlines of budget deficits of $1 trillion, and this was a huge wake-up moment for the country. And I got reporters calling all the time saying, oh my gosh, it's $1 trillion deficits. You must be so worried about what that's doing to the debt. And the answer, of course, was absolutely not. This is exactly what you want to be borrowing for. I'm worried about the fact that we're in the midst of a huge crisis where we could go into a depression, and what you need to do is borrow. And the US was very lucky at the time to have low debt levels of below 40% of GDP, which gave us not only monetary policy, but fiscal policy with which to respond. So you want to have the fiscal flexibility so that you can borrow when you need to, which is downward times in the economic cycle, and then you want to be saving in the upward times when the economy's strong. It's just that second part that we don't do very well. So it's very easy for us to know that we can borrow when we need to, but we don't do nearly as good a job of saving when the economy's strong again. And I think, and I hope, that we're right at that pivot point right now where we're starting to change from where the economy is really weak to hopefully it's gaining steam. You know, little worrying signs recently, but hopefully. Second, of course, is the question of what you're borrowing for. And there are consumption items, there are investment items. This is true for companies, for households, for government. For government, it becomes a little bit murkier what is what, because there is, as everybody's familiar with, a trick in Washington where you just call your favorite program, regardless of what it is, an investment. You know, it's an investment in farm subsidies. So that's a pretty tough trick. But certainly it is the case where it makes good economic sense to borrow to invest. But what I would say is that is true when you're not borrowing to do all your consumption also. And first, if you look at just take the government, if you look at how our government's spending, and when we talk about solutions, I would say reprioritizing how we spend is a top priority for the U.S. But you look at how the federal government spends, I did these numbers a while back, but it was roughly 84% on consumption, 16% on investment. That is not a recipe for success. And the problem now is that we're then borrowing so much for those consumption items. And then you see lots of people making the case, well, what we should be doing is borrowing to invest. We do need to do more infrastructure. We do need to do more education. We do need to do more basic R&D. A lot of the investment areas have been squeezed out of our budget. But the problem is when I hear these arguments that say, so we should borrow for all of those things, that makes sense when you haven't already borrowed for all your consumption items. So I think what we need to do is figure out how to pay for a lot of parts of the budget to free up the space for more of the investments and allow us to borrow for more of those. Just a third point very quickly that I would put on, it doesn't quite fit your question, but I think it was really important that came out of the report that you did. But when you think about when you're going to borrow more or less, we usually think about it as though the U.S. is an isolated economy, and we are not. And it matters tremendously. I remember I was at, there was a paper presented at Jackson Hole kind of on this topic maybe 3 or 4 years ago, and one of the parts of the discussion was we actually need to start thinking about when you go back into fiscal consolidation and periods of fiscal responsibility, which I think are different than austerity. They kind of are phased in more gradually. How different countries around the world that are all dealing with the high levels of debt are going to do this in a way that doesn't have very negative effects on the global economy. And I think your report kind of spells out the need to think a little bit more about how one country deals with its necessary consolidation with regard to what is going on around the world.
Okay, thank you. Doug, you come from a somewhat different part of the political spectrum, having advised John McCain's last presidential campaign.
Not my fault.
We don't hold you responsible. What do you think about what Maya said? So we can all agree that debt sometimes makes sense. We need investments, but we need to pay for spending. But I think maybe the devil is in the details on what are the good investments and necessary ones, and where should the spending cuts come. And I'm going to add in a twist, which is today we have record low interest rates in the U.S. They may or may not start rising soon based on what the Federal Reserve decides to do with monetary policy, but there are many arguments that it is a good time to borrow now to put in long-term investments because you can lock in rates at very low rates. But what do you think about good debt versus bad debt, and where would you see necessary spending versus unnecessary?
Well, let me echo Maya's thanks, first of all, to the group and to McKinsey for the report, and let me invest in a better answer. Maya laid out exactly the right conceptual framework. I mean, you want to make sure that you get a good measure of the cost and look at how you're spending the money. And there's one more circumstance in which we typically, as economists, advocate the use of debt, and that's if you want to borrow against future income. The standard of life cycle planning is early in your life you're borrowing, you hit your peak earning years, you're paying that off, and then they prepare for retirement. Let's just put that aside for the nation as a whole, because right now we're growing at, we can fight 2.5, 2 3/4, maybe 3 as the trend growth. The CBO pegs the long-term growth rate of the U.S. economy, the potential growth rate of 2.1% right now. So these are the good times. Enjoy. We're not anticipating more rapid economic growth and more income. So we don't want to borrow for that. Second thing I'd point out is that just saying infrastructure, it always sounds good. Infrastructure is like puppies, kittens, and sunshine. Everyone loves them. But if you take a really hard-nosed look at infrastructure, very little of it actually produces enhancements in productivity and thus increases in measured output. A lot of it's there as consumption items. And so when you invest in a wider lane to get to work faster and home faster, you increase your ability to stay at home later and enjoy that leisure. You increase your ability to get home faster and enjoy that leisure. You don't raise GDP a bit. And so there's a lot of so-called infrastructure spending that's really just consumption spending in advance and should be disqualified by Maya's criteria. There are some productive investments. The political system usually does not find them. It is not a ruthless seeker of high returns. It has a very different way of allocating capital. And so in most of the statistical work that looks for these sort of magic productivity enhancing investments, it doesn't really find that infrastructure beats private sector rates of return. So even at low interest rates, you've probably got a loser. Last thing I'd say is interest rates are not the full all-in cost. Given where we are with the projections of, for example, a deficit in 2025 that's about $1 trillion, $800 billion of which is interest on previous borrowing. So we are headed into a debt spiral as a nation. We are imposing a significant economic growth cost on the economy. And in increasing debt will enhance that growth cost, and the interest rate alone won't measure what we're giving up.
All right, that was, we'll follow up on we're heading into a debt spiral going forward. Sabrina, let's shift gears. On the website of the Independent Women's Forum, it says that all issues are women's issues. And I'm wondering, is there a gender angle to debt?
There is, in fact. That is our tagline, all issues are women's issues, but we also spend a lot of time focused on gender differences. And it may seem like I'm putting the cart in front of the horse by already talking about how we persuade people that the debt is a serious issue and that we need to make reforms. But it's important, I think, as we think about the kinds of approaches and the policies that we put in place, is how are we going to convince people of the need for this? And we have found that not only are there significant gender differences, but there's significant differences between parents and non-parents, mothers and non-mothers. And I think that this is all important as we think about good debt and bad debt. To both of your points, I was going to mention that in research that we've done, and it's on the tables, and I hope you'll take some time to look at it afterward, this notion of good debt, education spending, infrastructure, green energy, healthcare, in many ways, I think it's running a fool's errand to try to cut that. For starters, many people like this spending that we're doing. It's hard to convince people that spending in education is a bad thing. It's hard to convince people that spending on green energy investments is a bad thing. And we also know that, at least here in the United States, the main driver of our debt comes from our entitlement programs, namely Social Security and Medicare. And so better to focus on that than try to convince people of this much smaller piece of our debt. And then when we do this, I think there's sort of two main pieces to it, and again, it's laid out in the report, but first is, what message do we use in order to increase the number of people who want to have serious entitlement reform? And then, is it politically viable, whether you're a Republican or a Democrat? And I think there's some very good answers, but it also goes to the heart of how difficult it is to figure out what message to use. And so in the materials that we provided today, you'll find that it's interesting that when you think about it, there's a lot of different ways that we talk about the national debt, and we talk about stealing from our children, we talk about cut, cap, and balance, we talk about entitlement reform, we talk about national security. These are not all good ways of speaking about the national debt, and it's also confusing to the American voter. And I think one thing that we learn is that people have busy lives, they're not steeped in policy debates, and they don't necessarily make the connections from let's spend the same this year to we need to have serious entitlement reform. They just simply, there's a disconnect there. So for us, we found that among all respondents, a message that's focused on preserving entitlements for future generations is tremendously effective in increasing the number of people who want serious entitlement reform, meaning means testing, meaning phasing out of higher income individuals from these entitlement programs. And that we found among women and parents, it's a little bit higher, and especially among moms. And this is what I think is sort of fascinating. Among moms, there is an 11-point increase compared to a control group in support for serious entitlement reform. And I think it goes to this issue of gender differences. Moms are perhaps not consciously always thinking about it, but the security of their children, the security of their future. And when we talk about preserving entitlement, it gives them a sense of stability, and it puts them at ease. We're no longer talking about taking something away from them. We are, in fact, talking about giving them something that will benefit their family. So I'm happy to talk about the politics afterward, but I thought that was an interesting gender difference.
Very interesting. I like the preserving stability rather than cutting benefits. Maybe you can invest in preserving stability. Joe, you founded Global Insight. We use your data all the time. In fact, even in this report. Let's go beyond the US. I know that you do business in China with your new economic ventures, and indeed, have a good view on the global economy. What areas of the global landscape of debt do you find most concerning?
Well, thank you, Susan. Again, let me join the other members of the panel in congratulating you and McKinsey on that report. And I'm delighted to know you found some of our data helpful in the process. I am a trustee of the CED, and one of my jobs is to co-chair the Fiscal Health Committee of the CED. I co-chair that with Bo Cutter. And I care a lot about the U.S. fiscal deficit because that's a role we have here. But reading your report and seeing that there was $57 trillion of increase from 2007 fourth quarter to the fourth quarter of 2014 makes me feel like it's just lost in the rounding someplace what's happened in the United States, and not to worry about it. But we can come back to that later. To get to your question, I'd say that the place that worries me the most is, of course, China. Of your 57 trillion, 21 trillion, or about 38%, I think that is, of it was all in China. And most of that debt was generated by the government. And when we talk about good debt and bad debt, I can find an awful lot of bad debt in China where they're really not getting the return on a lot of the investments that they made. I found myself in the unusual position. It was the third week of September in 2008. I was the keynote speaker at the annual National Bureau of Statistics of China Outlook Conference looking ahead to 2009. And imagine being on the podium and telling them what you thought was going to happen. But they were terrified by what was happening. They saw their trade falling off very rapidly. They went into an enormous stimulus program. And they really didn't have the same problem we had here in the United States with subprime lending and needing to bail out banks and things of that sort. Their problem is unemployment. They really want to keep everybody working. It's one of the best ways to maintain political harmony and control over the country. It's a pact that the Communist Party really has with the people, that everybody should have a job. They tried to move about 10 million people a year from the rural areas to the cities. Mostly that was going to the coast. So there's that constant influx of new workers. Now they're starting to bring the cities to the rural areas. But I think a lot of what's driving the debt, not only in China, but in other parts of the world, is unemployment. Let me just stick with China for a moment. They undertook a massive stimulus program, and much of the problem is structural because the way they got the money out and got it out very quickly was through the provinces and through the cities. 31 provinces and 600 cities suddenly were empowered to issue debt. And they did that very rapidly. And you can imagine when you're moving that fast, mistakes are surely made. And the consequences of those are beginning to be felt, but I don't think they've been thoroughly felt yet. And you're still seeing the Chinese government trying to maintain some stimulus. They just had a recent report of the fourth quarter GDP at 7%. That's disappointing for them. They had a target of 7.5. I think it's going to fall for the full year probably to about 6.5. So they're continuing to take on more debt. They're not done yet. And I don't think a country has ever seen a quadrupling of debt of that magnitude in that short a period of time. And something bad is surely going to happen. Now, looking at the rest of the world very quickly, I don't think we should be surprised that the world is awash in debt. First of all, we did have the recession, and we had the stimulus programs that we had here in the United States and in Europe in some places, and particularly in China. We had the bailouts, which took more government debt. But all along with that, we've had really cheap money. Short-term interest rates, for the most part, real rates have been negative. So you're really getting paid to borrow at the short end, and we've had a massive amount of quantitative easing pressing rates down at the long end. So when money is virtually free, it's kind of tempting to use it. And I think that's what's happened not only in the United States and in China, but all over the world. If you look at it by other sectors getting away from the government, the financial sector, of course, is taking advantage of this. And we're seeing deals, again, being debt financed at astronomical numbers. Now, that's not always true. Sometimes you see deals being done for stock, but the only way I can buy your overvalued paper efficiently is with my overvalued paper. So that's why you'd have stock in those cases. But there's still a lot of money going into deals that's debt financed. So the financial sector has participated in that. And I think households have tried to maintain their real income levels during a difficult period and have taken advantage of debt when they can get it. You've certainly seen more debt being taken down by emerging markets. The commodities markets have gone into a tailspin, even more so now with the oil price drops, and that's put strains on emerging markets, and they're taking down more debt as well. You do have to remember, we see increases in debt. You have to look at where each country started from, too. I mean, you look at China and say, oh, they've taken an enormous amount of debt down, and something bad surely is going to happen. But their debt to GDP ratio is about the same as the United States right now.
All right, very good points. I want to follow up very quickly with the second round of questions so that we can start to get questions from the audience to bring into this discussion. Doug, I want to start with you. We haven't talked about behavioral economics, which sounds frightening, or student debt, which is frightening in a different way. U.S. student debt is now $1.3 trillion. That's the second largest form of individual debt in the United States, second to mortgages, so it now surpasses credit card debt and auto loans. And student debt continues to grow. We've talked about unemployment on this panel and on the previous panel, lack of opportunity for young people, and yet at the same time they're paying record sums for getting the education that it has. Thoughts on U.S. student debt, and does it pose a risk to future stability? Could it create a crisis?
So I think the starting point for the student debt discussion should be the underlying product that's being financed, and that's the college education. Point number one is that the problem starts well before college. If you want to get a very quick predictor of someone who either will take 5-6 years to finish or will not finish, find a student who needs remedial help in their first year in college. It's the single best predictor, and there are lots and lots of them. That's a K-12 education failure that's pervasive in the United States, but it adds to these debt burdens. You've got students with many too many years in college at best coming out, or not finishing a degree and having a high level of debt. Those are the problem loans that we find most quickly. Second thing is, the generic issue of what do we do in getting a better value proposition out of America's higher education. I won't dwell on that, but that's a very important discussion that has the feel now of the healthcare discussion a decade ago, where we have a system into which we pour basically open-ended federal subsidies for a product of highly uncertain quality at ever-increasing cost, and so we're going to have to come to terms with that in some way. Third is we have, in the course of moving everything onto the education department's balance sheet and direct loan program, really replicated some of the bad aspects of subprime lending. The origination of these loans is really poor. They're originated, handed off, no one's responsible for the future of that loan. It's a very bad set of incentives that ought to be rethought from scratch, and we'll get better origination. We can also do better in getting the students themselves who fall in arrears back on track. I think that's something. It's going to take all of those things. The levels are high. They're not projected to come down, and it is a debt problem. The fact that it's a student debt problem, I don't think is as significant as just the debt load early in the life cycle before taking on other traditional debt loads like mortgages and cars and the like.
Right.
I get a point.
Sure.
At the risk of offending academics that are in the audience, I think another driver that I worry about is the cost of higher education,
Yeah.
which has increased a lot faster than the CPI or the growth in GDP, and it's kind of steadily increased. And I often wonder to myself how much of that is a supply side phenomenon, which has been aided by student debt. And you see, when you see all the student debt there now that people are starting to default on, you think about how does a student approach higher education now, thinking they're going to get into that same trap. We've got to get more productive in higher education.
Yeah, and unlike mortgages in the United States, where if you default and hand the bank your keys, you write off the debt, you walk away, the bank, not legally, but in practice, will not come after you and your other assets and income in most cases, but that's not the case with student loans.
Right.
There's no defaulting and getting rid of student loans. For the rest of your life, that debt will be hanging over you. Let's go to Maya really quickly. Infrastructure. Okay, so we all accept that maybe infrastructure is an investment and maybe it makes sense to borrow against it. But Doug has said, look, a lot of infrastructure isn't really needed. And I think it is a very interesting conundrum as an economist to think about, while we don't like sitting in traffic on the Beltway, the fact that now we have an easy pass lane and we get to where we want to go faster, maybe, does it add to GDP? Historically, the U.S. has had a very politically driven process for determining what infrastructure is needed and funded. There are now different ideas for how to do it better. Chicago is trying to raise an infrastructure bank that would take the decisions for funding and allocating and prioritizing projects out of the hands of the government and put it into a bank. We now have a new tax proposal by the White House to have a one-time tax on corporations, foreign holdings of cash to pay for U.S. infrastructure. There are a lot of different ideas swirling around on how to either finance or do it better this time. Any thoughts on what makes sense to you?
Okay, one point on the previous two comments, which is I just think it's no surprise at this point when we see using our tax code to subsidize certain things that we want more of, home mortgages, education, that we then drive up the cost of those things. So there's this huge irony, or it sort of backfires, that the policies that we're trying to subsidize and allow people to have more of, we're actually pricing people out of the market. And we know that the benefit of that is captured by those who produce the things that are subsidized. And home mortgages, maybe we'll talk more about them, but home mortgages, student lending, we're just seeing a real lack of of effectiveness of what we're trying to do in those areas. On infrastructure, I'll just throw out a big, I'm not sure, good idea that I've been playing with for a long time in this. But it's the point, I mean, I kind of mentioned it, Doug kind of mentioned it, but once you get something that becomes popular and politically popular and everybody just gives it a big warm hug, and that's where we are with infrastructure right now. You better not go out there and say anything against infrastructure, because it's one of the only areas that kind of has bipartisan support, and it's come to symbolize what is good and what we should be doing more of. But what we don't do is we don't do nearly tough enough analysis on any of the government policies that we look at, whether it's spending or particularly those that are done through tax expenditures. When we create new tax expenditures, there is so little economic assessment of what the returns on those things will be. And I don't know how to change that in our political system, other than outsourcing a lot of the decision-making away from the political process to technocrats or outside commissions. But whether it's how you reform healthcare, where you put your infrastructure dollars, what the best things to, when you're talking about deficit reduction, where the best savings are going to come from, the things that are least effective, how to broaden the tax base, I think we need a lot of expert input. And so I would say on infrastructure, it's sort of the perfect example of, gosh, I mean, so many people don't like IPAB. I can see how many people would hate this kind of idea. IPAB is the group that's supposed to come up with different healthcare savings areas if our healthcare costs are growing too quickly. But I really like these models. And I think finding groups of experts who are as removed from the political system as possible, having them say, here are the infrastructure infrastructure investments that would do the most good, because there's a difference. Widening the lane so that my commute is shorter and I come home and have chance, 15 more minutes each day with my kids is lovely for me. Widening the lanes or doing something else that allows people to be more able to get jobs they wouldn't otherwise get does increase productivity. So we need to really dig down and figure out which ones work and which don't. But I think outsourcing a lot of the analysis, the recommendations, doing some things like IPAB where those changes could become defaults unless Congress decides not to go with them. It's not very democratic, but I think we would probably end up with a lot of better policies if we started looking at some models like that.
Just two quick points on this. First, I want to be the person to praise the broken Highway Trust Fund, because by being broken, the way they put money into it, they have to basically do general revenue transfers, which means the Highway Trust Fund is now competing on a level playing field with everything else in the budget and every other national priority. That's how it should be. Why we would give this earmarked handout to the Transportation Committee on a regular basis, I have no idea. So it's broken, keep it broken. Second thing is, inside that system, there is no requirement by and large for economic analysis of the use of transportation dollars. And there are some of the places, Kansas City Metropolitan Transportation Planning Board, the Chicago Transportation Planning Board, where they do economic analyses, cost-benefit analyses, trying to use the dollars to get the high-value productivity-enhancing investments. Kansas City requires that the analysis be formally put into the decision-making. Chicago does the analysis and throws it away. And we've then looked at the outcomes. And all we really need to do is embed in the process more requirements for planning and use of planning in decision-making so that we'll get better use of the dollars.
Yeah, and another McKinsey Global Institute report from 2 years ago found that the difference in what we call productivity of infrastructure spending is a delta of 30%. So the difference between the best executed, planned, prioritized, constructed, and maintained project gets 30% more return, or conversely, you could say would cost 30% less to build than the poor performing one. So huge opportunity there. Let's just finish up with Sabrina. You thought had some thoughts on how politically we can make this conversation more palatable, and then I want to take questions from the audience. Just raise your hand. There are roving mics. When you stand up, please tell us who you are, and please have a question.
Well, I don't know how many people, when in Washington, I should ask this question, but I'm a huge fan of the show House of Cards. I suspect many people are here. And I bring this up because I thought it was rather poignant for those of you who watch the show now in the release the third season, that the issue of spending and the issue of entitlement reform and the issue of the national debt still in many ways remains this third rail of politics, that we simply can't talk about it. And if you're a lawmaker and you broach the idea of entitlement reform, for instance, which I still see as the bigger issue than, say, entitlement spending, but Social Security spending, Medicare, Medicaid, that somehow you will be laughed out of Washington. And I think part of the problem we have is we have to get beyond this idea that people are not persuadable on this issue and that this is somehow a political landmine for lawmakers. And certainly our research found that for both Republicans and for Democrats, this is an issue that they can win policy-wise as well as politically. And so I'll just mention that it's not a secret that the Independent Women's Forum is focused on economic liberty. We're more right-leaning, but we were still interested in what this might mean for progressives. And what's interesting is that the progressive message that favors investment in infrastructure and education and sort of spending our way out of the national debt doesn't actually backfire. What it does is it primes people to think about the problem at hand. And the problem people realize is large. They may not understand it perfectly, they may not connect all the dots, but they recognize that there is a problem. So simply having this debate today is going to impact people's opinion, even if we differ on the policy solutions. And I think that's important to point out. The second point is that when people say, well, how should this congressman talk about this issue? It's complicated because we have two different goals. One is to affect policy change, and the other is for somebody to get reelected and to stay in office. And so we know, for instance, that if you talk about the issue of the national debt in the context of national security, for instance, this is not effective at increasing support for serious entitlement reform. But it does substantially increase support for the GOP. Perhaps not surprisingly, I think it just reinforces this idea that Republicans are stronger on defense or stronger on national security. It doesn't really have a connection to spending, but we have to realize that we can talk about, there's many, many different ways that we can talk about these issues, and they're going to have different impacts. Now, something that I think is encouraging, and it goes back to the issue of gender differences, is once again the sort of winning message is this one about serious entitlement reform. It not only boosts support for the GOP among all respondents by about 3 points, but among parents and mothers, it's dramatically effective. It increases support for serious entitlement reform and for the GOP by about 7 points, which I think is sizable. And I think it should be a sign to lawmakers that they have a winning policy and a winning political strategy. And so I would encourage, especially as we go into the 2016 political season, for lawmakers to really take this issue and to get behind it and not to be scared to discuss it.
Okay, do we have questions from the audience? Raise your hand. Well, all right.
Thank you for your insightful thoughts. I'm Ron Klein, one of the trustees, and just wanted to ask a question on transportation. I was in the state legislature for many years, and if you're in the state legislature, you're obviously dealing with a lot of local infrastructure issues, whether it's airports, roads, backlogs. Yes, it's definitely the popular thing to talk about, the fact that roads are backlogged, or bridges, and all those kinds of things. So, Doug, in your comment, you said that it was broken, and therefore, I assume you don't like trust funds for the reason that it's an automatic system there. But what is your view on the transportation? Do you think, I'm sure you agree that there is obviously some issue there in terms of some transportation needs. I think I would certainly agree with you. It's not everywhere, it's not everything, but there are certain targeted things that should be well thought out, and the question is, how do you pay for it? So what's your view at the federal level? Is it just a question of debating general revenue every year and fighting that out among other priorities? Is the concept of some type of other funding source? What's your view of that?
So I have always felt that it belonged in the general appropriations process, that it was appropriate to have it compete with other needs. We do other kinds of funding for infrastructure, water resource development, things like that. We build some very long-lived assets in the appropriations process. We have a space station. We have weapons systems. There's nothing about using the general appropriations process to build highways that it should be a problem. And I think the notion that the gas tax is a good user fee model has become a piece of history. And so, I think the times have just sort of passed, and we should give up on the trust fund at the federal level. The second thing I'd emphasize is, there is no defining rationality to federal transportation policy. There are 100 different federal transportation programs, and not one of them identifies the federal objective. And I believe we ought to reform that transportation funding system so that we say the federal responsibility, the federal objective is growth and economic connectivity, and we have clear interest in having the federal government keep the nation effectively connected. That's not a highway issue, that's a multimodal issue. It should be mode neutral. We have trains, we have airplanes, we have ships, we have cars, trucks, and so the funding should look like that. That's what the federal government should take care of. It should then give the money to the states and regions for the preservation of the regional public capital stocks, where the folks in state legislatures and municipal governments are much better situated to know what their needs are, what's replacement, what's new investment, and what makes sense. And I just think we need to rethink this literally from top to bottom. One of the reasons I don't want to fix the Highway Trust Fund is it'll just cement in 1950s era thinking in a time when that just has to go.
Comment?
Yeah, other thoughts on the panel about the topic of U.S. infrastructure fund?
Well, on infrastructure, I think the interstate highway system is a real treasure, and I'd hate to have to drive from New York to Los Angeles and pay a toll every 25 miles, even if it was with an Easy Pass. But I do think there are opportunities where user fees would be appropriate to privatize some of the infrastructure spending. And that's been done in a number of cases, and we see it in a lot of other countries too. So when there's an opportunity to do that, private sector can come in, they can raise the equity, raise the debt, fund it with debt, and pay it off with user fees. And there you have an economic analysis.
I was just going to add it, and again, maybe this is the gender side of things for me, but it's interesting to have the conversation about infrastructure spending at the same time as we're seeing the workplace changing dramatically. I work in a virtual office, so for me, I'm thinking about this as money taken out of my pocket to make somebody else's commute easier. Now, I'm not denying that we have serious road problems. I sat on 95 for about 4 hours the other day. I could barely park around here. We have water main breaks all the time. There are legitimate infrastructure concerns, but I think we have to recognize that it's not simply an investment when you're taking the money out of another part of the economy, and what's going to increase the GDP is productivity. And when my tax dollars are being put into something because we arbitrarily think that people should go to an office and that they will somehow be more productive in that setting, I think we're missing the larger point of how you create wealth.
Interesting point, and I would add to that when we talk about infrastructure, we think about roads and airports, but broadband infrastructure is perhaps the most one of the most important parts of infrastructure in the 21st century, and enables you to work from home, enables startups, enables the whole rise of what we're calling the fractional economy. So the Uber drivers and the people who will clean your closet on TaskRabbit and so on and so forth. There's a very rapidly expanding set of people spending a few hours each week, but it's all enabled by internet and broadband access. And the US is actually among advanced nations, has very mediocre to poor scores in terms of how many people have access to either 3G or 4G broadband, and the cost of accessing it is out of line with other major advanced nations. Other questions or topics from the audience?
Don Peterson, also trustee. My understanding, and I'm going to betray my limited economics background, was that sometime in the last decade or so we changed the mandate of the Federal Reserve to not just kind of manage the economy and inflation in particular, or avoid deflation, but also to foster full employment. And it seems to me we perhaps have lost a voice for managing the long-term balance in the economy, which may be why no one is really speaking out in concern of these large deficits. What happens, not so much if we increase the debt, which is going to happen, but if the interest rate increases fourfold, our budget is way out of bounds. But it seems to me that in prior time, we might have had a stronger message from the Federal Reserve in that area, and now because they have this dual mandate, they've become short-term oriented to a greater degree than might be optimal, and I was wondering if that thought resonated at all with Joe or any of the other panelists. And the other question, when you get done with that, my favorite is, that you don't like, is since the federal government owns the Federal Reserve and they own 25% of our debt, would consolidated accounting solve the problem?
I'll answer that one. Yes. 25% of the problem.
Well, as I mentioned in my opening remarks, I thought that one of the major drivers of the amount of debt that's out there is low interest rates, and the low interest rates have been in part driven by that mandate. Absolutely, that's, the Federal Reserve is called to account on how well it does on maintaining employment, and its mandate used to be just to provide stable inflation and stable monetary policy. So, absolutely, it's a tool that's been given to them, and a mandate that's been given to them. And I think it'll be interesting in retrospect to see just how do we get out of it. That chapter is yet to be written.
So I just want to point out, I think the political economy of this discussion on the debt, the deficit, and especially the entitlement spending is about to change. It's already starting, and the political economy changes at both the top and at the bottom. So at the top, anyone running for president in 2016, and everyone is running for president in 2016. Is anyone here running for president in 2016? I mean, you know, they are all going to have somebody who's going to look at these projections that show that in 2024, we've got this $1 trillion deficit. It's basically all interest. That's with interest rates assumed to be relatively benign, 4.6% 10-year rates, things like that. And no president is going to want to preside over the entry into a debt spiral. They're just not. That means that on their watch, something's going to have to change. And it's not a super political strategy to surprise the American people with a big change to Social Security, Medicare, or some other part of the social safety net. So they're actually going to have to start warning people that things are going to change, which is very different than the you get to keep Medicare as you know it, we're never touching Social Security conversation that is traditional political talk. So it's not going to change dramatically overnight. 16 there'll be a little bit, 20 there'll be a lot more urgency, but that leadership from the top is going to have to change. That's the best public education. Presidential candidates talking about what has to happen. That's when you can actually educate people. And then once in the White House, that gives White House air cover for Congress to actually do its job. Something's been missing and made it very hard for them to get it done. So I think that part of the equation is changing. At the bottom, the grassroots level, the dynamics of the budget are that the mandatory spending programs are crowding out national security, basic research, infrastructure, education, all the things the founders might have recognized as the role of government. They're just getting crushed. And we've codified this in these caps that we put into law a little while back. And the groups behind that are very unhappy. You're seeing the defense sector say, no, this is, we are not safe, number one. 1 out of 3 battalions is ready to go for deployment. The other 2 aren't. And that we need more money. So they want to have entitlement reform. I mean, the Defense Department folks want entitlement reform because they need the budget room. The non-defense, same thing. I mean, I talked to the Non-Defense Discretionary Coalition, the worst named coalition in Washington. They get it. These are research universities. They want their funding for their engineering programs. They're not going to get it unless we get entitlement reform. So from the top and the bottom, we're going to finally have advocates for reform, as opposed to, budget geeks who want reform and everyone else who says, no, we just like what we're getting.
I think it's a really interesting question because I think the interest component of all this is really critical. And you just look at it from the budget perspective, interest payments are the single fastest growing part of the federal budget. That should be staggering to everybody. And when Doug said that we're in an interest rate, we're headed toward a dangerous interest payment cycle, this is a potential crisis, and it's one that people sort of don't realize. Rates go up 1 percentage point, and that will add $1.3 trillion to our interest payments over a decade. That's the amount of money the super committee was supposed to come up with, which they were unable to do. That's 1 percentage rate increase. And all I know when I think about the Fed is, boy, do I feel sorry for them. Because, they had this huge, huge crisis they had to deal with. And then on top of this, they had, if monetary policymakers are doing their job, then they basically were stuck where either they were going to kind of compensate for the fact that fiscal policymakers were in no way doing their job, or the changes they made were going to harm the economy dramatically, which would then get in everybody's way. And so I think that the debt in so many ways has come to reflect the broken system in Washington. I think the fact that we have the debt where it is, the deficit has come down, it's been cut in 2/3, even though that came after an 800% increase. But the debt remains twice what it has been historically, twice what it was when we went into a crisis. We are in a terrible situation in terms of our levels and the trajectory, and yet nothing's getting done. We're adding more to the debt on a regular basis. At every opportunity, we continue to increase the debt. And I think, if nothing else, it kind of is a reflection of the broken situation in Washington. I think about Doug's point, 2016, I think this is the real opportunity. We're doing a ton of work in Iowa and New Hampshire right now in a program called First Budget, where we're out there in those early states trying to talk with people so that they will talk to everybody running for president saying, please make this be one of those campaigns where you fight over who will be more fiscally responsible, not less. And I think there's a good shot of it because, as Doug says, whoever is president, assuming they want to be there for 2 terms, they cannot avoid this at all. It will happen on their term. And the other issue is, while there really is deficit fatigue inside Washington, we've made so many runs at a big budget deal and it wasn't able to get done, and people are kind of sick of the issue. If you go outside into the states and you talk about it, people still really get that it's a problem. They really understand, they don't understand the difference between deficit and debt. They don't understand $1 trillion, none of us do, but they know there's a problem. When you first start talking to them about what the solutions are, they're not happy. When you talk about Social Security, when you talk about Medicare, when you talk about raising revenues, when you talk about reducing the home mortgage interest deduction, none of this is fun stuff. But if you continue that discussion enough that people understand what's actually involved in it and what you get from getting control of the situation, sort of the aspirational part of this, but how the track that this puts us on from the economic growth perspective and what we can do for our economy if we get control of it is so good. There's so many things that are on our side in terms of this country's economic prospects. And you fix this with some still manageable, tough but manageable changes, you can really unleash so much potential. Then people get on board with making a lot of those difficult choices. And so I'll just, things will change on this issue, either from leadership or crisis. They will change because they have to change. But when you go out there in the States and talk about these things and the potential solutions, it becomes so clear that responsible spokespeople and real leadership on it will be able to make that happen. And so I think this 2016 discussion is going to be very critical.
I passionately hope that Doug and Maya are right that this is the time to address it. At the CED, we started to raise alarms about the budget deficit and the total amount of debt. Back in 2006, we did a report on global imbalances and how that was, there were twin deficits in the United States. At the time, the current account deficit was very high, and the budget deficit was going up at the same time, coupled with low private savings. So we started back then, and ever since then, we've used every opportunity that we can possibly create to bring together Republican and Democratic politicians, political leaders on the Hill, the members of the budget committees, and encourage some active dialogue and compromise. And we've been there just as Maya has been with Fix the Debt, when there's been closing the federal government, failure of the super committee, needing to really repair the sequester, and we can't really get people to sit down and work on it. And I hope that in the next couple of years, we don't have to wait for the crisis. It would be a wonderful thing if we could have a dialogue and a campaign about the issue. Maybe, Sabrina, some of your findings are saying it is possible to do this, but we're trying very hard to do it. Right now, we find everybody we talk to is waiting for the election, and they all feel like their side's going to win, and they'll do it their way, so they're not ready to address it yet. But we'll keep trying.
Well, I want to thank everyone. We are now out of time. This panel has left me oddly optimistic. It's a panel on debt and the global
That wasn't the goal.
But I hear that in the next 8 years, we're going to grapple with entitlement reforms. I've heard that voters like that issue and want it to happen, both from political research, but also out in the States. At the same time, I can think of several policies which would slow the growth of private sector debt while enabling the government to have more breathing room. Somebody brought up the mortgage interest deduction. We could talk about corporate debt interest deductions. We have a system that favors debt, both through our tax code, through the Federal Reserve policy, which, by the way, I support, but we can take that offline. And not surprisingly, we have a lot of debt. But it seems like all of this is coming to a head when you think about what the federal government is going to owe on it, on interest payments on the debt. And I've heard different reasons to think that this will be an issue with us for the next 6 to 8 years, but that maybe solutions, in fact, will be at hand. Thank you.